Hello traders, welcome to another lesson. In this lesson we're going to be looking at a very crucial element also in your trading known as risk management model. So actually trading is a very risky venture, but if you can implement a risk management model that really blocks, or rather it blocks you from losing a big amount of your capital in maybe per trade or something of the sort, then you'll, because what you want to do in trading, you want to be focused on the longer term objectives rather than short term objectives. Yes, I know the short term objective is I want to make money right now, but you want to really focus on being in the trading career or industry for a long time. So this tool, risk management model, is what is going to help you really stay in this industry for a very, very long time. So as I've outlined, this is one of the most crucial tools that you must have in your trading. This is not negotiable. You must have it. If you want to really do well in trading, you must have this. So I will outline an example here of a risk management model that you can use, but it's not necessarily that you must use this model. There are very many variations of risk models that you can develop and use, as long as you have a risk management model that you're using and you're following. So it's not just having a model, but it's actually using that model in your trading and being disciplined to follow all the rules. So in this example, we have two elements. We have the drawdown management and we have money management. So drawdown actually is, for example, if maybe you're starting with an account of $5,000 and the first trade you take a losing trade, maybe of say $200, then we will say that you're in drawdown, meaning that you risked $200 and you lost that. So your account is now running at $4,800, meaning you're in $200 drawdown. So what you want to do is you want to manage that drawdown, because you do not want to take the next trade an equal measure of the risk. So in this example I've outlined, first of all, the maximum risk per trade should be 1%. So when you're even talking about a $5,000 account, it means 1% is $50 risk. So 200 is already an overshoot. $200 is a 4% risk. So that's already an overshoot of what the maximum risk per trade is allowed. And this is an example. So you can formulate your own, but this is an example of how a beginner should really begin in terms of defining your risk. So in this example, we'll just use the $200 just as an example, but in real sense, just follow a maximum risk per trade of 1%. Now, if you take a loss on the first trade, then it means you reduce your risk. You reduce your risk by 50% after that trade loss. So it means the second trade, you're not going to risk $200. In this example, you're risking now $100. So if that $100 goes into a loss, then you reduce further by 50% to $50. So I've outlined here that the maximum you want to reduce, maybe it's 3 stages. So this is a minimum of 0.25%, which is now the minimum you'll use to recover that drawdown before you can now go back to 1%. So if you once you recover the drawdown, say by 50%, then you can start using the normal risk. Either you can just start going back to 0.5 and then 1%. And then another thing, you reduce your risk by 50% after 5 consecutive winning trades. What happens after winning trades consecutively? There tends to be that overconfidence that builds up. So you want to really cap that by reducing your risk instead of increasing it. And then under money management, this is just an example. Let's say you have an account of $5,000. So when I say $5,000, and in this example have a maximum drawdown limit. Say in that $5,000, you're saying you do not want to lose anything more than 30% of that account. Meaning, if it is $5,000, 30% should be, so if it is $5,000, then it means 30% is $1,500. So you'll be using $1,500 to now calculate 1% of that $1,500 rather than the $5,000. So we are assuming that $5,000 is your maximum trading capital. So maybe even just for example, you have $5,000 in your bank account. Then you take 30% of that, which is $1,500, you deposit into your broker. So that's what I'm trying to outline here, that you're not using the maximum capital to trade or to frame 1%. So that will even reduce further your risk. So risking only 1% of that 1,500 instead of the 5,000. And then the other way you can even reduce your risk even more is maximize your trade per session. So you can say that you're trading only 2 trades of maximum per session. So if you lose the 2 trades, then you stop that. Maybe if it's day trading, you can stop that day and come back tomorrow for more trades. Instead of just going trade after trade after trade, you can just maximize your trades and say, I'm doing 2 trades per day. And if I lose 2 trades, then I'm focusing on tomorrow. I'm reevaluating everything, the bias, the narrative, the trades that I'm taking, and taking new trades the next day. And then another thing you want to do is reduce your trading in high volatility or risky market conditions. We have already outlined low probability conditions, so you can check on that. And then use minimum risk in high volatility or risky market conditions. So you can use 0.25% as a maximum during high volatility or risky market conditions. So this is an example of a risk management model. This was actually done in Excel. You can easily do this and just frame your risk. So I've outlined here the approximate risk. So you can select, maybe you're doing 0.25, 0.5 and maybe 1%. Then you can track your trades and see if you're following the model. We have some rules here that you're aiming for 3-to-1 risk to reward. You're reducing your risk by 50% on any trade loss. You're reducing your risk by 50% on 5 consecutive wins. And also you're using the lowest risk to manage drawdown. Holding your trades, meaning you're aiming for that 3-to-1 to be achieved, but you're also taking partials. And then you can take partials at 2R or a set number of pips that you can decide is easily achievable. Then you should have a weekly objective and a monthly objective, and that 3-to-1 should be also an average objective for your risk to reward. So more on risk management, this is an advanced step that you can take even further. Is the first thing you want to do is leave a runner after booking profit. So maybe you have booked 3R, so you want to leave a small runner. It could be even 20% of your initial position. This will actually really aid you in paying for those mistakes that you make in the past, that you made in the past that resulted to trade losses. So that runner could be really useful in really increasing your equity even to a higher level. And number 2, you always want to take partials. Always take partials. This will really be useful in your trading. And then aim for those low-hanging fruits, the nearest liquidity, the nearest order block or fair value gap. Don't over-target when you are doing your targeting. Then aim for 3-to-1 R multiple. And you also want to reduce your risk by 50%, just as we have outlined. You want to do drawdown management. And then also, just as we have outlined, use a maximum allowable drawdown. This is actually a concept that I found that prop firms are using. So although they use a 10% or so drawdown, maximum allowable drawdown, but you can set your own, maybe a 30 or so, whichever you're comfortable with, to reduce your risk even further. Finally, you want to have objectives. So you want to have a weekly objective and a monthly objective. So this is just an example, but for a beginner, you can set this at 50 pips and a monthly objective of even 4%. That is way high. 4% is just, it's easily achievable, and it's really, you're doing well, because 4%, it's barely even the yearly rate of if you're saving in a bank. So the R multiple average is 3R. So that is just an example of objectives that you can set for yourself. Lesson exercises. So you want to implement a workable money management model. So this was just an example. You can do your own example and see what works for you, but you have to implement something that manages risk. You also have to have weekly and monthly objectives. So just start with small achievable objectives, and then as you continue gaining experience, you can increase to whatever you're comfortable with, and you can see that it's something that you can achieve. So thank you so much for watching. So I think the next lesson what we'll do, we'll look at some of the rules that you can set for yourself, and from there we can start looking at a trading plan example that you can now use as an example to formulate your own trading plan. Depending on which trading style you will be trading, the trading plan will be unique to you. Thank you so much for watching. See you in the next lesson.